Good evening, everybody. A lot of questions surrounding the move of markets into year end, and I think it's really worth us sort of taking a little time to having a look at where we are and where we might go from here. And where we are right now is, roughly what the market's been focused on recently. So let's have a look at that. It's the pace of the Fed and other central bank rate hikes, not so much, where they end up. I mean, the initial focus has been on, will they continue doing 75? Will they move to 50? That sort of thing, and that applies to all the central banks, to be honest, all the way from, the Fed all the way down to the RBA and the Bank of Canada, and, that we saw in the last couple of days. So are they moving away from bigger jumbo rate hikes, the 75 basis points? It looks like they are. Stock market traders have become relatively optimistic in recent weeks about this slowing of rate hikes, which has been seen as a risk-on event. If you look at the USA 500 weekly, we've had a climb from the lows around 3,500. We've bounced up from those lows, a 17% bounce. We're beginning to we've seen the last 4 days of weakness, but that bounce on this Chair Powell talk that smaller interest rates are coming through did actually give the stock markets quite a boost. That boost seems to be flattening out a little bit and losing momentum. So where are we right now? If we look at the central banks on the left here, you can see the interest rates around the December 31st, where they were. Interest rates 31st of August 2022. They're rising pretty quickly, 3% from the RBNZ, 2.25% in the US. Interest rates for 7th of December up to 4%, 4.25%. These are quite steep moves. Now, the thing you have to remember here is that monetary policy like this rising of interest rates works with a lag on the real economy. So we're not quite sure how much this very quick rise in rates, how much damage this is doing to the economy just yet. This will come through in first quarter, probably next year. We're unsure how much influence this is having because these moves have been quick, unusually quick, to be honest. Even the RBA, who've been taking their foot off the gas, have got interest rates at over 3% now. So this is really quite interesting. Looks like the ECB's got quite a bit more to do, but this idea of moving from how quickly they were hiked has evolved into what the eventual peak will be. So not how fast, but how far. And I think this is the key. And this is maybe what's sort of seen equities start to sort of roll over recently. This 4-day sell-off that we've seen in the S&P is possibly on the basis that the Fed is being very clear that, okay, we may be slowing rates, but we might be higher for longer. And that is a key component for risk going forwards. Fed speakers have been mixed on this view a little bit with the peak on rates. We've had a slightly dovish Bostic and Daily looking at a peak around 5% or below. Brainard seeing a string of supply shocks, keeping inflation high, suggests possibly higher for longer. Bullard, the normal hawk he is, very hawkish indeed, looking for 5% plus as a peak in inflation. As a peak in rates. That's a big signal for bonds, but Powell is the one to listen to. Now, Powell is actually quite clear that whilst they are slowing rate hikes or the pace of them, they could be higher for longer. And I think equity markets are beginning to price that in a little bit now. Certainly bond markets are, because the signals from the bond markets are slowdown in the US economy, if not recession, and therefore the idea of hiking a great deal longer is at risk, but that's not what we're hearing from the Fed. The Fed is very clear that they are going to continue hiking until they get inflation down. Yes, we have peak inflation, but we do not have inflation anywhere near 2% goal that they have in mind. So can this potential Santa rally be any different? Look, we don't always get a Santa rally. I mean, this idea that it comes every year is just a fallacy. It just doesn't happen. I mean, sometimes we do, sometimes we don't. The markets are going to have to be data dependent. Why? Because the central banks are data dependent. So this is huge data run into the end of the year. So I think we need to sort of take a quick step back and see what data did last week. We saw after Powell spoke, actually, traders were hoping last week's data would be a green light for further buying of stocks. The Tech 100 had bounced strongly on 3% on Powell's speech. We flatlined a little bit. We've come off, and now we're looking vulnerable again in this market. We dropped 2% and the bounce of 1.5% on non-farm payrolls release. We've rallied a bit, but it's now rolling over again. Inflation continues to overshoot its 2% goal by some margin, as you can see on the chart on the right here. And, to be honest, employment and wage growth exceeded forecasts, particularly the wage growth. There is still tightness in this labor market. The Fed is a real believer that you cannot have a recession when you've got a tight labor market and almost record low unemployment. They have a point. And, this wage growth suggests that there are still inflationary pressures on the economy going forward. So the Fed is clear of where they're looking at to set data and set policy rates, and that is clearly unemployment and wages. So what are the known key events that we know? Well, there's still many things impacting the chances of a Santa rally, particularly starting from now. We've got baby steps towards China reopening. Is that enough to really get the markets bullish? It helps, but it's going to take a while. Russia response to the oil cap, what's that going to be? Are they going to sort of limit supply? Is that going to be more inflationary? Although one has to say oil has come off quite a bit recently. Central bank speakers, we've got quite a few scheduled events. Now, I think the scheduled events we need to look at are clearly in front of you here. So have a quick read through of these because they're vitally important. I'm going to cherry pick a couple. The US CPI data on 13th December is the last inflation input before we get the FOMC meeting on the 14th. Now, that is vital information. I think it could influence the Fed to some degree. We've got UK inflation data as well on the 14th, just as the Bank of England is about to announce their rate decision as well. But obviously, the Fed meeting, the FOMC meeting on the 14th of December is the biggie of the week. Are they going to suggest a soft landing is still possible? Are they going to suggest that inflation is still doggedly high? What are they going to do? What's the next move from the Fed? That is what we're going to try and focus on in this meeting. And this could set the tone into year end, because I think the markets are just about done for the year. But this could actually set the tone into year end quite easily, depending on what they have to say. And I think rather than the meeting, I think the market is pretty clear that they're going to do 50 basis points. But it's what they have to say on this in the press conference, I think, is going to set the tone. So that's really important. Bank of England as well, as I said, and the ECB meeting on the 15th, massive. Now, preliminary global PMI data on the 16th of December, I think, is also really important. This PMI data has been weakening. We've got manufacturing deep in recession. My point is here, if services start doing the same thing and moving below 50, we've got a problem in the US and elsewhere in the world, because at the moment, the consumer is holding up services to some degree, but there's some fears there that the consumer is doing a lot of this buying via credit cards, which are expensive and it's unsustainable. So we need to keep an eye on that data. It's forward-looking data, vitally important. But what about the dollar? Dollar index, DXY, has fallen steeply since the end of September, but we're seeing a bit more of a mixed bag now. I think the move is more of a two-way market right now at the moment. Dollar and stocks risk are negatively correlated, obviously. So basically, if we see stocks lower, you'll generally see the dollar higher. And, stocks really sort of rise and we've got a big risk on move, you'll generally see the dollar lower. But, have we got a peak in the dollar? I think we have. But that does not mean that we're going to trend down in a straight line. But what I am seeing on the charts I use is kind of like lower highs and lower lows, which is definition of a downtrend. But I think this dollar index is at risk. I mean, it's a mixed market, particularly with the lack of liquidity in the markets coming up in the next 2 weeks. Will the dollar continue its move lower to finish in 2022? From here, it's a tough call. Yes, I think a peak's in, but from here, the dollar move is really difficult to judge. We're off the lows. The euro is back around 105. They're not massive moves in the last 3 or 4 days, but it's interesting. I think a lot of this depends on what stocks do. So if stocks start to fall hard, the dollar goes up. I think if stocks rally from here, then the dollar probably comes off again. So I think it's all about risk at the moment. But the signals from the US bond market is still very negative on the state of the US economy. So bond market's forward looking, equity market should be. So to me, one of the sectors is wrong. Either equities are wrong or bonds are wrong. And in my 40 odd years of experience, bonds are usually right. So it'd be interesting to see where stocks finish the year, but everybody, well, a lot of people are hoping for this late rally to sort of take the pressure off stocks. So what is the bigger move into the year end? Stocks or the dollar? Well, they do move negatively correlated together to some degree. US services index unexpectedly rose, as you can see here on the chart on the right. Again, if this starts turning down with the negative implications of what's going on in manufacturing, if this sector starts rolling over as well, then I think we're looking at a recession in the US. Now, that data may not start to move down until the first quarter of next year. I also think unemployment data, that also lags the real economy, what's going on in the economy, by several months. So are we going to get the shock in unemployment moving higher in Q1? I think there's a chance of that because I think these policy moves have been quite strong. And I do see quite a lot of evidence of some of the big tech firms and certain other sectors shedding staff pretty quickly to try and maintain margins, which seem to be disappearing rather quickly. So, the health of the US consumer is paramount. Their sentiment, the outlook for recession, inverted bond market yield curves are a concern, and central banks are all hiking at different paces. They're not in lockstep here. So that means there's opportunity in foreign exchange markets to some degree. So what would the ideal stocks, the individual stocks possibly to look at? I think we need to look at the growth stocks. What is driving this? So if we look at things like Caterpillar in the US, they are a multinational company that sells into the construction industry with bulldozers, diggers, all the rest of it. So if construction is buoyant around the world, Caterpillar usually does well. So keep an eye on that because some construction data out recently, particularly in Germany and the UK, it's been pretty weak. Germany especially, I think construction PMI hit 41.5, really low. A concern about the construction industry going forward, concerns over global growth, and the sort of continuing problems in China also capping global growth. So demand is something we need to bear in mind here. So Walmart and Target are the retail behemoths, slightly different structures. Target doing pretty badly, that too much inventory, selling stuff cheap, collapsing margins, poor outlooks. Walmart slightly better, but these are the bellwether for consumer spending habits. So we need to keep an eye on these as well. Of course, Apple, Amazon, etc. They're the big tech, mega techs, if you like. Solid businesses, but remember the fine margin that Amazon works on. So wage rises and things like that really eat in to very fine margins. And we need to bear that in mind. And if we are looking at a recession in the US at some point, how many people are going to want $1,000 new phone? I think they may be holding on to their phones a little longer. Apple, if it's a global recession, it will hit companies like Apple as well. As good a company as they are, there is risk here. So I think we need to sort of look at how we're going into the end of 2022. There are risks out there. There's a lack of liquidity into the end of the year. So volatility is almost confirmed, I think, unless the market just decides enough's enough. They've all squared up and nothing happens. It's unusual, but the Santa rally has some risk to it. Don't just believe because it's a catchphrase that everybody uses every year. It doesn't always happen. So on that, I'll leave you, and I will wish you a very Merry Christmas, and I will wish you a great New Year's trading, and we'll see you back in January. Cheers.